Well, the minutes reflect the final meeting of Janet Yellen as chair of the Federal Reserve, and it's fair to say that the legacy she leaves is a very strong one. The growth rate in the last quarter of last year was 2.6%, above the trend rate. That followed even higher readings in the second and third quarter of 2017. Wage growth is now running around 2.9%, so it's shown a bit of an acceleration. And broadly speaking, the Federal Reserve as a result has been feeling confident about lifting interest rates gradually from here. The only question really about that legacy at the moment is, first of all, whether financial markets are at unsustainable levels, and there obviously have been big movements in markets in recent weeks. And secondly, whether inflation is going to finally start coming through, as the Fed has repeatedly predicted. Most economists are expecting around 3 rate increases this year in 2018. The Fed really cemented or anchored that point quite firmly in its statement, saying that it expected further gradual increases in rates. That use of the word further emphasizes that there's further to go in terms of tightening monetary policy, that this is an ongoing process and not one which necessarily is about to reach a conclusion anytime soon. So the market turbulence really erupted almost at the same time or shortly after the departure of Janet Yellen, so it's really first order of business for Jay Powell to decide how to react to that, if at all, Jay Powell being the new Federal Reserve chairman. So far, comments from other Fed officials have suggested that the Fed isn't particularly concerned by what it's seen, the very, very sharp moves in equity markets in the recent weeks, and also the movements in bond yields have not elicited strong reactions by the Fed. So far, I think it's safe to say the Fed will look at this as a bit of gyration or a little bit of excitement in markets, but not something that's going to force it to change policy.